specifically. My name is Michael Green. I'm based in Sunham S4's Washington, D.C. office. For those of you who aren't familiar with us, Sunham S4 is a global market entry firm that helps companies, higher education institutions, nonprofits, handle the complexities of entering and expanding in global markets. So this is everything from market research to hiring, firing, HR issues, accounting, tax, cross-border banking setup, company and corporation. Again, I'm based in Washington, D.C. Pleased to have the CFO of the company, Kapildua, here with us, along with Abhinav Sood, who are both joining us from New Delhi. Sunham S4 is global. We have offices across the Americas, Europe, Asia, and the Pacific. We have many clients on the line who we serve. FTSE 100 companies, Fortune 500 companies, but a lot of the companies that we work with are in the mid-sized segment, startups as well, who are looking for added revenue opportunities in foreign markets. We encourage you to learn more about us on our website at www.sunham4.com. We have webinars there, blogs, and profiles on Abhinav, Kapil, myself, and others in the company. I'll lay the ground rules for today's webinar. We're going to end in about 45 minutes. We're mindful of everyone's time. We have a lot of ground to cover, and encourage everybody to ask as many questions as you would like. This webinar is really built for you to clear up any uncertainty that you might have about the budget for your business. We're going to be covering a lot of tax issues specifically in this update. Anything that we don't get to in the 45 minutes, we're happy to follow up with offline. What I'll do is provide a brief overview of the budget. Abhinav is then going to focus on some of the policy implications, and Kapil will then follow up with the specific tax, direct and indirect tax implications of the union budget. I've been following union budgets for a number of years now, and this one, I think, was a move towards practicality. They moved the budget back from February 28th, when historically has been announced to February 1st. This was to give more time for bureaucrats, government officials to really get things sorted before the end of the year. I also think it was a move from the extraordinary to the ordinary, in that the government has been announcing big bang reforms over the last several years, not waiting for the budget to really make these announcements. So whether it's bankruptcy, insolvency code, FDI reforms have been announced throughout the year. In the past, the government kind of waited for the budget to move these things forward, and I think demonetization is another example where the government didn't necessarily wait for the specific moment to make the announcement. Instead, they're really taking measures throughout the year to further their initiatives, whether it be Make in India, Digital India, and others. One of the other major kind of structural changes to this budget was that they rolled in the railways budget into the broader government budget. Previously, these were two separate budgets that ran kind of in parallel to each other. India has one of the largest railway infrastructure in the world, so that's a huge part of the broader budget. Now kind of consolidating that will give more clarity kind of across the board. into a couple of the big bang reforms that kind of came out before the budget. GST continues to be one of them. We did a webinar just a few weeks back on that subject, and I think Kapil will cover that a little bit more in detail in this presentation as well. But that's expected to get rolled out in July. Again, demonetization was another big shakeup that is probably only expected to see about 0.5% impact on GDP, a real short-term impact because it did, shake up mainly small locally based businesses that are based on cash. But it was a true blessing for fintech companies, for payment companies, because you saw millions of individuals kind of opening bank accounts, setting up accounts to be able to transfer money electronically, which is a big part of the broader agenda of Digital India. Some of the key economic indicators, which you can see on your screen, include inflation. Inflation continues to be under control. The deficit is down. India has also benefited from lower oil prices, which it hopes to continue, but is doing other measures to, in the long run, have the deficit around 3%. This year, India is going to experience a projected 7.1% growth. That's the fastest growth globally, outpacing China and other major economies in developing markets. Next year, the range that they've set for themselves is 6.75 to 7.5. Again, I think right up there in terms of the fastest growing global markets. And I just read a report actually from Edelweiss this morning about India being, considered one of the fastest, steadiest growth economies in the near to midterm. So with that, I think, again, what we're focused on here is answering any questions that you might have as we work our way through this presentation. So please feel free to ask them, and I'll pose them to both of our experts, Abhinav and Kapil, who have done quite a bit of work kind of going through the full budget and pulling out some of the key impact items for foreign businesses specifically. So Abhinav, maybe I'll turn it over to you to move to the next slide, and apologies in advance if I interrupt you with any questions.
You have been muted. Thanks, Michael, and definitely a very practical budget, as you rightly pointed out this year. I would go a little bit further in saying that this budget was very pro-domestic. It focused a lot on policies for the poor, policies for farmers, for the small and medium local enterprise, the indigenous producers of the country. But at the same time, there were a few proposals that were announced which directly impact foreign organizations who are planning to or currently doing business in India. Our webinar is just focused on those specific implications. And of course, there have been other implications as well in terms of taxation for individuals, in terms of routine audit procedures, which we've not covered in the webinar, of course, but will certainly impact long-term engagements in India for organizations, both for-profit and not-for-profit. Having said that, I'd like to just take you through some of the key policy announcements that have been made in this budget. The first and the most important one is the proposal to abolish the Fipb, that's the Foreign Investment Promotion Board. That's a big change for all foreign organizations. For those of you who aren't aware, in India currently, foreign direct investment is under two separate broad umbrellas, so to speak. One is the automatic route, where you don't need to get any prior approvals before bringing in capital into India. And there are some conditions attached for various sectors. The other is the government route, where you need to take prior approval from the Fipb before getting in capital and setting up a direct investment route into India. Now, this government has proposed to abolish the Fipb, and a roadmap for sort of phasing out of Fipb is going to be laid out very soon. This is a very welcome move. Over the years, as this government has been liberalizing a lot of sectors, opening up a lot of sectors. I think in the last 2 years there have been at least 20 to 23 sectors that have been further opened up and passed through into the automatic route. So and then there have been other changes in terms of permanent residency, relation of regulations for non-resident Indians or persons of Indian origin or overseas citizens of India. There have been more and more advancements and in the sectors like defense, aviation, pharmaceuticals. So with this, the impact of Fipb has certainly lowered, and this is a very welcome move by the government to phase out Fipb altogether. It remains to be seen how this will play out in terms of approvals which are required in future. Will they be routed through post facto intimation, or will they be routed through the direct Ministry of Department of Industrial Policy and Promotion? Then another big change that has been announced is a complete overhaul of payment and settlement systems. The payment and settlement systems regulations in India govern all sort of digital payment gateways, wallets, quasi-banking solutions that are offered by a lot of private players, both foreign and Indian, in the market. So keeping in line with the changing needs and the changing technologies, they have come up with new proposals in the last couple of years. I think it's a very good move to consolidate all these proposals and do a complete review of the existing regulations. This will go a long way in opening up the sector further, and also allowing the RBI, as the Reserve Bank of India, to have a more sort of a watchdog role rather than a very proactive sort of bureaucratic role it currently plays in this sector. Another big change is the merger of advanced ruling authorities for all taxes that are currently existing in India into one. Advanced rulings is a mechanism where you can approach tax authorities before litigation begins or before you initiate a transaction and get a ruling on your transaction. How is that to be taxed in India, and what are the tax treatments? So that is again a welcome move. I think it will again go a long way in reducing litigative procedures in India. A big change that has been announced by the government is change in how political parties are funded, and how post demonetization this government is focused towards moving from a cash intensive economy to a cashless economy. It's obviously impossible to completely wipe out cash from the system, but this government is making a lot of efforts in reducing the dependency of cash in the Indian markets currently. Kapil will of course announce some discuss in detail some tax proposals that have been announced, but for example, electoral bonds have been issued for political parties, which will sort of reduce the dependency of direct funding, and it will be routed through proper banking channels now. And then of course tax proposals that have been made are very, very important. The last and the most sort of relevant for capital market players all over the world is a few changes that have been announced for all policies related to capital markets or the financial sector. I can give some examples. For example, the registration process for intermediaries like mutual funds, brokers, or managers has been made fully online. So that's a welcome move. It will be much faster and much more transparent in this manner. There's a common application for all tax registrations, demat accounts for foreign portfolio investors now, so that again reduces a lot of time lag for the registrations that was required for these portfolio investors. There's a proposal now in place to have a framework for spot market and derivatives market in commodity trading, which is another sector that's being opened up for capital market investment. And there's also a bill for resolution in financial firms. So some of the all these key changes have been consolidated, and there's a big effort in reducing any bureaucracy or lags in processes for capital market players in India. These are some of the key policy changes, and of course, Kapil will definitely talk about the tax proposals in more detail.
Thank you, Abhinav. Thank you, Michael. Good morning, good evening, good afternoon. Let me now straight away jump into the tax proposal, which are very relevant for the next year, which is the financial year from April 2017 to March 2018. And let me start with the very important and probably applicable to most of the small and medium-sized companies who are thinking to set up in India or who are already in India. So the government and the finance ministers have announced that the tax rate for corporates have been cut down from 30% to 25%. So new tax rate will be 25% for companies who are having sales revenue of less than 500 million INR, which would be say 7.5 million US dollars. So that's definitely a welcome change, which will gonna benefit to small and medium companies who have that kind of a threshold in their revenue. Second important change is the MAT credit, so minimum alternative tax. So India do have this tax, which is generally work in India in terms of tax on your book profit. So which means India has two kinds of tax calculations. One is tax as per the company law, and other is the tax as per the income tax law. So MAT, which is a minimum alternative tax, is generally paid by the businesses on their book profits, which means when you calculate the profits as per company law, you are still supposed to pay tax, and the current tax rate is 18.5%. So what the government of India has done, that even if you are not supposed to pay tax as because you might have some tax exemption under the Indian Income Tax Act, but you might be paying the minimum alternative tax, which is computation of tax as per company law, and that tax rate, the credit of that specific tax has been increased from 10 to 15 years. So now any MAT tax which you have paid in previous, say, 10 years or even more, you can take a credit of that tax for over 15 years against the tax which you're supposed to pay in an income tax. So it's a little technical, but if you already have your company and business in India, you will realize that this minimum alternative tax is a big threshold or a big limitation for companies to pay taxes in India, even if the tax laws say there are some exemptions. So it's a very important and welcome change, I would say. The next, again, important is domestic transfer. So India did introduce almost 3 years back something called domestic transfer pricing. So earlier what was happening, that transfer pricing laws and regulation were applicable to transaction only between the foreign and the Indian companies. But they introduced that even if the transaction are between related parties who are, both the related parties are in India, the transfer pricing regulation were applicable to them. It's a new welcome change which they have done in that law, that now as per this change, the domestic transfer pricing will be applicable only if one of the two Indian related entities are enjoying some tax exemption. So for example, you have two Indian companies, one is for profit, the other is not for profit, and there are some transactions, so domestic transfer pricing is still applicable. But if both of your Indian companies having transaction between each other, but the tax rate to both of them are say 30%, then you are out of the domestic transfer pricing. Of course, there are threshold limit, which is 200 million INR. If you have that kind of transaction, then only it is applicable. But this is definitely welcome change, which is given in this new budget. There has been some change, which is very particularly important for foreign organizations, which is related to transfer pricing. So if you are having international transactions between your, say, foreign holding company out of India and Indian subsidiary, if there are transactions, of course, transfer pricing is applicable to you. The new change which they have come up now, it's called primary and secondary adjustment. So any adjustment which has been done to your transfer pricing returns, which you have filed or study and basis of your arm's length pricing, they have come up with a new concept called primary adjustment and secondary adjustment. And to be honest, they have defined what. So if they have defined 4 or 5 types of adjustment which are secondary, and if it doesn't fall into secondary, that means it's a primary adjustment. And what the new law says, that if it is a primary adjustment done to your tax return, the transfer pricing return, then any addition made by the assessing officer in your profit, then it's a notional interest calculated, and you need to bring that extra income into India or pay tax on it. And one of the primary adjustments which they have defined in India is, for example, you have filed a tax return in India saying you are following a method of cost plus 15%, and the assessing officer say no, it has to be cost plus 18%, and he would like you to keep more margin in India, say by 3%. Now that addition made by assessing officer, if it doesn't agreed by you, and that addition of 3% into your transfer pricing margin would be called as a primary adjustment, and you are supposed to pay tax on it, even if you're still litigating and filing appeal against that order, which is I would say it's a very litigative until the government of India, before it is passed by the President of India. The finance budget is supposed to get passed by President of India in the next 2 months. They need to bring some sort of clarification to this. Otherwise, this is definitely a very, very big litigative decision, or I would say a change which government of India have done in terms of transfer pricing. So I can definitely explain more when you have a specific question, but this change would definitely affect your business in India. Like Abhinav and Michael said about the demonetization. So the finance budget have some elements of demonetization as well. So where they have said they have reduced the cash transaction limit for one transaction from 20,000 Indian rupees to 10,000, which means that now you can make a cash transaction only up to $150. So if you want to make a transaction for more than $150 in cash in a day, it's not allowed. So I mean, of course, you can what people were earlier doing, they were making multiple transactions in a day. So that's all been also clarified. So you cannot make a more than $150 transaction in cash in a day. So you need to watch out what kind of petty cash expenses you need for offices, and probably explain more or ask your vendor to accept more online payments. This is all to encourage for online banking, online payments. One of the other important change which the government of India have done in this finance budget is to keep on the same element which they had earlier about the reduced capital gain tax of 10% for non-residents. So what we had a couple of years back, which was introduced a couple of years back, is the reduced capital gain tax for non-residents. So, for example, if you're a non-resident, you have assets lying in India, and you have sold those assets, and on selling those assets or shares, you are supposed to pay capital gain taxes in India, whether it's a long-term or short-term. There was a provision in the tax law which says you can simply pay 10% tax on your capital gain taxes, and there will be no problem of long-term or short-term, because the short-term capital gain tax is almost 30% in India. So that provision has been extended even retrospectively. So if the transaction has happened almost from 1st of April 2013, this new tax of 10% will be applicable. So it's a very good welcome change. They have also clarified the indirect transfer. So indirect transfers are now not applicable to FIIs and FPIs, so foreign institutional investors who were transacting Indian assets. So, for example, foreign FIIs have assets in India, and they have sold those assets to another non-resident Indian, and earlier this was called as an indirect transfers, and the tax were paid, supposed to be paid on that. And now the government has clarified that any such indirect transfer made by FIIs and FPIs are not taxable in India. And some of the other important clarifications. Yes, Michael.
Hi, Kapil. Sorry, I have a quick question. In terms of each of these bullets, whether it's the 25% kind of reduction or some of the indirect transfer provisions, are all of those implemented, Feb 1 onward, or do they all have different implementation timelines? Or maybe if you could kind of explain exactly when these hit, do the companies have a chance to kind of adjust?
So generally speaking, all these changes which have been made in the finance budget shall be applicable from 1st of April. However, it all depends how quickly and easily this finance budget is signed by President of India. So this will become a budget and once it is signed by President of India. And these changes have been proposed from 1st of April, thinking that the finance minister will get signatures as per the new timeline, because he has preponed the budget from 28th February to 1st February. He has 2 months to get it signed and make these changes applicable from 1st of April.
Just to add there, unless specified, it could be also specified in the budget that there are some provisions which are applicable from a different date than 1st April. For example, Kapil mentioned that the tax rate for 10% for non-resident shareholders now goes back to 1st April 2030, because that is specified in the bill itself. Also, if you look at the tax rates for 25% for corporates, the 500 million INR revenue threshold is decided for FY 15-16, because that is what is mentioned in the bill. So there are different dates if specified in the budget that are applicable retrospectively. Otherwise, it would obviously be applicable from 1st April, as Kapil rightly pointed out.
Okay.
Right.
Okay. Thanks. Sorry,
yeah. Let me now. Sure, no problem. So let me now move to the next slide. Again, on the tax issue and the changes in the tax. So one of the other important tax change which has happened in the capital gain taxes. So what we had in India, we have something called long-term capital gain taxes and short-term capital gain taxes. So any asset which you have hold or which you have held for more than 36 months, and you sell those assets after 36 months of enjoying the assets or being held by you, then it is called as a long-term asset. So that means any tax which is supposed to be paid on asset which is held for more than 36 months would be called as long-term capital gain taxes. And long-term capital gain tax is lower, tax at a lower rate, which is around 20%. And short-term capital gain tax is on all those assets which you have held for less than 36 months. So Government of India have, just to give more, a benefit in terms of reduction in capital gain taxes, they have reduced this period from 36 months to 24 months, which means that if you held an asset for more than 24 months, say 25 months, that would also be now considered as a long term. So which means a lower tax rate. So there is definitely this reduction of 12 months from 36 to 24. So lower tax rate if you're enjoying that asset for more than 24 months. Similarly, they have, in order to minimize their loss in terms of taxes, so they have there was something called indexation. So you were supposed to index and bring your cost inflation when you bought the asset, the cost of asset. They have changed the cost inflation index from the earlier, which was very old, from 1981 to 2001, which means when you compute a long-term capital gain tax, you are supposed to bring your cost and bring that cost into current scenario, and you are supposed to do the indexation, which was earlier the base of that indexation was 1981, and now they have taken the base of 2001, which is a bigger base. So that means the tax would not be reduced as such, like they have done that 12 months reduction, but there is definitely overall there is reduction in the long-term and the long-term capital gain taxes. So they have given some more tax benefit to the startups. So earlier the startups were enjoying the benefit of tax holiday, tax exemption for 3 out of 5 years. Now they have increased that to 7 years. They have also widened the scope of gift taxation. So we have something in India called gift taxation. When an individual is, earlier the law was when an individual is making a gift to another individual, and he's the person who is receiving it, he's supposed to pay the taxation on it because he has received this gift. Of course, there was no gift taxation when the asset or shares are moving from within the blood relationship. Now they have widened the scope by saying companies, firms, when one company is gifting some asset or shares to another company, that would also be qualified for gift taxation. So now the taxation will be applicable on it. And they have also increased in terms of other benefits. So for example, the time limit which has now been I would say reduced from the specific elements in terms of revising the tax return. So now earlier the tax return were allowed to be revised within 24 months of filing the tax return. Now you can revise only up to 12 months. Because what happens in India, if you have made any mistake, you filed your original return on time before 30th September or 30th November period, which was a deadline for filing your annual tax return, there was a period of 24 months that you were allowed to revise your tax return, because if you made any error or mistake. They have reduced that period to 12 months. However, they have also reduced the period which was allowed to the tax officer to assess those tax returns. So they have suggested that has been reduced to 18 months, and in the period coming forward, it will further be reduced to 12 months. So there is no earlier it was almost a big time given to the tax officer to even scrutinize a 2 years old tax return. Now they are thinking to reduce that to 12 months, which is good enough, which will also strengthen the tax refund processes, which will also strengthen the procedure and maintenance of books, so that your books and accounts can easily assessed by the tax officer on time. So that's also a very good welcome change. Now, moving on to the next slide, which is again some more points on the tax, which is probably more relevant to the non-profit organizations. So what happens in India when you are a not-for-profit institution? You register yourself as an entity which is a Section 25 or a trust or society, even if you're a higher education or you are doing other non-profit activities in India and you want to set up your own entity, and you were supposed to go for a specific tax exemption, and those tax exemption were 12A and 80G, specific section of the Income Tax Act. Now they have made a very important change in the tax law, that once you have filed the tax exemption with the Government of India with your main objects of your trust or society or Section 25 company, and in future, if you want to change your main objects of your non-profit entity in India, then you need to go for separate a new tax exemption, because in between, if you change your main objects, then the tax exemption which was given to you earlier, what based on the old objects, so the activities and objects. So now they have said that if you make any change in the main objects and activities which are allowed to do by your Indian entity, and if you make any changes to that, then the tax exemption needs to be reapplied. And similarly, the other important change that they have done. So, for example, you have a non-profit in India, and you receive some grants and donation from your donors, and you have given out of the grant which you received, you want to give some portion of grant to another non-profit. Earlier, the grant were counted as expenditure, because, for example, you receive $100,000 as grant. You have, out of $100,000, you have given $50,000 to another non-profit, and you were counting in your books of accounts as the $50,000 which you have given to another non-profit as your expenditure. Now they have said that you cannot count that as your expenditure. You have to make this part of your corpus, because when you're making this to another non-profit, you're making this as a grant again to another non-profit. So it will not be counted as your expenditure. It will be part of your corpus, and they will prescribe new rules and regulation. How would they count for those specific transactions when it is part of corpus? So these were the few key important, I would say, direct tax changes which are applicable to foreign entities, foreign organizations who have subsidiaries and business in India. Now, some of the indirect tax changes, first of all, not big changes, not many changes in the indirect tax law, because as Michael and Abhinav said, the new goods and service tax is about to come, and it is, as of now, the government and the council, the GST council, GST network is is set up to have the new GST law from 1st of July. And that is one of the reasons they have not submit or proposed many changes in the indirect tax law, which is whether custom duties or excise duties or service tax, which most of the Indian companies and businesses were thinking that they might increase the service tax rate, which is currently at 15%, and the new GST rate, which is expected for service tax, is around 18%. So everybody was thinking that current service tax rate might go up from 15% to 18% for at least for next 6 months till the time the GST is coming, just because the new GST is saying 18. So it will be easier for people to cope up with it. But they have not. So the current service tax rates stand at 15%. The other excise and custom duties stands where it was earlier. They have just made a one of the change by removing the research and development cess, which will be abolished from 1st of April this year. And rest of the changes are not very much applicable as of now, or they have not done many changes because they are waiting for the GST law to be passed and enacted very soon. So those were some of the very important changes for direct tax and indirect tax.
All right. Well, Kapil, thank you very much for that overview. I hope we have several tax experts on the line, because we got into a lot of details there. You know, at this point, I think we're coming up close to 45 minutes in. I hope everyone can hear us, you know, Kapil, Abhinav, and I very clearly. I saw some feedback on that. So hopefully that's clear. But in terms of what's next for the folks who are on the line, we're going to be following up with this presentation for all the registrants, all the participants, and we're happy to speak with you kind of directly if you have any specific questions. I think a lot of the tax changes that are coming down the pike are going to be very positive, provide a lot of clarity for companies, nonprofits, and others, but there will nevertheless be a lot of kind of growing pains in terms of the mechanics of it all. And in terms of, you know, my experience working, I joined Sunum S4 about a year back, working closely with Kapil, Abhinav, and our clients. I've seen directly how, you know, they're able to kind of navigate from a very practical perspective how to address these changes. India continues to be a very dynamic market, and I think going forward will continue to be so. The changes that are being made, I think, are driven largely to move a lot of the economy from what it has been fairly, you know, I think 80%, numbers range, but Kapil, Abhinav, correct me if I'm wrong, but, you know, 80%, 70% informal economy, bringing that economy formalized through digitization, increasing the tax base in terms of everyday the Adman in terms of the everyday Indian kind of paying taxes as well. So I think all of these changes are going to be very positive, but again, they will come with growing pains. So with that, I think, you know, stay tuned. We'll continue to have these updates for our clients and for our for the companies, foreign companies that are looking to enter India. For any specific questions, please feel free to reach out to us. Happy to answer them at any time. But with that, Kapil, Abhinav, I don't know if you have any final words, but we'll wrap it up and wish you a good evening, and everyone else who's joining us from perhaps Europe, US, a good day, rest of the day ahead.
Absolutely. Thank you very much. Thank you. Thank you, everybody.
Thank you, guys.
Bye.